The investment methodology is essentially a flexible one. I think that you need to look to, in a world of great uncertainty, to opportunities that exist both from a top-down perspective and also from a bottom-up perspective as well. So I'll look for opportunities in the duration space, which will reflect my views on inflation, growth, where we are in the economic cycle. And then from that, I will have an asset allocation view. I have some flexibility within my fund to own some high yield or to own government bonds, as well as the main focus on investment grade. And from there, along with the credit experts that we have, the analysts in London, we'll select the individual bonds that will make up those allocations dependent on valuations, opportunities. I think if we're generalising, we see the best risk rewards in the non-financial corporate sector. So we still have some serious concerns that relate to the banking sector and to sovereigns. So that really leaves a cohort of non-financial corporates that are in good shape, whose spreads look very attractive on a long-term historic basis. So you're being paid high risk premia for lending to these companies despite their balance sheets being in good shape. So the focus would be either in investment grade on those companies where we see value, or in high yield where we also find opportunities for lending to companies that are well capitalized, have good earnings prospects, and offer a very attractive risk reward. So I think part of what we've seen recently in the sell-off for high yield has been the market repricing some of the growth risks that exist, and I have a lot of sympathy for that. We've felt for a long time that growth in the Western world would be anemic, would be quite slow. But at the same time, actually, we find a number of individual companies, once you do your credit work, that actually can operate in that kind of environment, and their spreads have widened, the risk premium has gone up significantly. So where we can lend to double B corporates, for example, at 8, 9, 10%, that looks very attractive to me. And even some single B and even triple C companies whose yields are much higher in the 10 to 20% type of region looks like a good risk reward, as long as you've done your credit work and you understand the dynamics of that individual company. I think there's definitely a risk that we see a deterioration of balance sheets from where we currently are. But my view is that we've started from a very, very good base. So all of the excess of the last 5 or 10 years has really been within the banking system and in the sovereign space. So companies have focused on cash flow preservation, paying down debt. So the starting point is a very good one. So they really have the ability to withstand a deterioration without it being a real concern for me as a creditor. I don't think you can say the same thing for the banking sector or for sovereigns. Great.
Thanks.
Thank you.